Hello, everyone. Welcome to Losers Become Winners for July 16, 2020. The Tigers take the lead with Verizon at 22%. Let's go look at that chart. And there it is, 22% for Verizon in the Tigers. And so the Verizon is moved up to 22% here. Our stop is now here at the lower end. And this is the price channel. The Tigers are doing price channel. That's what these color bands that you're seeing here are. There's the there's a blue, and then there's blue, green, and black are my color codes for the price channels. So there we are on 22% for Verizon. Moving on now, the other leader of the pack for the Tigers is TLT. Now, TLT is your ETF for the benchmark for home loans. So when they quote on home loans, they're using the TLT, which is the 20-year bond, and the 20-year bond. But the 10-year bond is a much more popular one. And its stop is not moving. Why? Because the price channel moved up to the dipper zone. We have 165.22, and we are staying at 165.22. Alrighty, moving on now. UAA here comes in. UAA, it's leading the. It's only got a 6% obligation there, and its stop is at the moving average line, not not the price channel, not the lower part of the price channel. Why? Because it reached its middle zone rule. Positive territory under 30% is the price channel, the moving average, or the dipper. The dipper is way down here on UAA. So we are here at the 30-day moving average to go hold on to the 6% and with anticipation of some more move up. And there it is. Tigers price profit zone moving average exit at 6.69. Okay, that it concludes the Tigers. The laggers are Duke and Luke, so we'll let them stay where they're at. Duke and Edison, and go on to the alphas. Now here at the alphas, our leader is XLU. XLU is running, and get some control here of the screen so we can make things look pretty. Yes, okay, here we are. Here we are. So, and recall, now the alphas is running the 30-day moving average theory. This is the contest between which of the two is the better of the two, plus what is the performance. Also note, in the 30-day moving average, we are using the close is opposite of the trade. We'll get into these exits right here, seeing that very dramatically pointed out over here on two exits that occurred. Capri joined us today. That's what the green is about. So XLU at 16%, and we're waiting to get to that 30% ROI, because when we get to 30% ROI, we'll initiate the second exit rule, which is last bar high or low, depending on which direction of the trade. Going on now, PGR is over here. PGR is right there, and PGR is has a look at this action. This is really cool. Now this is the drawback about the 30-day moving average. On the exit of the close, we have to wait for a close below the 30-day moving average. That's why we have the second rule in place. Take profit. 30%, you get that 30% profit, take that money off the table, because if you don't, the next trader next to you will. And then that will collapse price, that will drop your value. And then we also note 30% when compounds doubles your money. Now, we did have a 12% a couple of days ago on an exit for the Tigers. That happens. But with the anticipation is get over to 30%, it falls back to our exit. We get out with 30% profit, do that 3 times in a row, and we have doubled our money. Okay, our next leader for the alphas is XLV, and XLV is running here, and it had a little bit of a fallback. You can see right there, and it's under 30% rule. So again, we're still here on the second. We are waiting for that. So there is no third condition in the 30-day moving average. Now, there is another exit that you have seen during the past 9 months of this channel, and that is that when we touch the zone, we get out. We're not doing it on this one because we're applying the original exit rule, which is the close opposite of the trade. That's the original exit rule, which has been that was and so let's get down to these two exits here. Yeah, talk about exits. I forgot completely forgot. Yeah, let's go on now to TJ Maxx. What happened here? Let's take a look. So what happened here was uh we were in a put. You see right there what I put. Closes opposite of the trade. Well, the opposite of the put is for a downtrend. We got moved closed above the 30-day moving average here. Got it. The stop was put there, and we got stopped out here, and we took 716 is the date, not the loss. We lost 20% in 9 days. $82 loss per contract, three contracts, 246, about $4 in fees, about minus 250 plus a carry of 1741 with a new O of 1991 for TJ Maxx. And we'll be now also to note we are also match condition to get into the trade for the 30-day moving average. That's our condition. Close above the 30-day moving average, up, and the histogram is in positive territory with uptrending indicators. So we'll be looking to see if this will further qualify for a entry into a call for TJ Maxx. That said, let's go over to CVS. CVS is right here. And CVS also had the same situation, closed above the 30-day. It was a put, two contracts, got stopped out, and the interest was 476. We got paid 425. So the loss came out to $51 with two contracts and 102 minus $3 for the fees, 105 for the total loss in the trade with a new O and carried loss of 26.21 with a new O of 27.26. And these things happen, and the loss is not going to, in my mind, my vision, and the way I operate, and you have guys seen this for the last 9 months. We get the red sweater guy. That means I want all my lost money. Now we just, this series just started July 6th. That's 10 days ago. 10 days ago. So it's got a lot more running room until December or until we have a major cataclysm between now and then. We'll see what happens. All right. With that said, we're going to close out today's report of Losers Become Winners. And I thank you very much for stopping by and checking it out. And closing slide. And there it is. Verizon at 22% for the Tigers. Thank you all. Take care. Bye bye.